So in the last module, we looked at what traders actually trade. Personally, I found it really useful, so I'm keen to find out what we'll be studying next.
Well, in this module, we are going to cover the basics of trading. We will look at what buying and selling is, the markets where trading takes place, and the associated costs. And finally, we will look at the role that brokers play. This last part should be interesting, as it will explain how you will interact with the market as a private trader.
Where do we start?
We start with defining what a market actually is. I briefly described what a financial market is right at the start of the course. Can anyone remember what I said?
Yes, I remember. You said it was where everyone involved in finance, like banks, investors and traders, come together to carry out transactions.
Exactly. These transactions are where the price of financial instruments are agreed. What I described was a free market, which is already pretty well known to us, since we live in market economies. For example, we already know that house prices increase when there is a property shortage. However, there are other types of economy that produce very different markets. Planned economies are where production, investment, income, and crucially for us traders, prices are set centrally by the government.
Great, that makes sense to me. So would we ever trade financial securities in these planned markets?
No, we wouldn't. By definition, we aren't able to, so don't worry about them. Just be aware that they exist. The financial markets we discuss, analyze and trade are largely all free markets. A free market is where buyers and sellers trade using their own free will to determine the price. As traders, we are interested in the price at which these buyers and sellers are happy to transact. We are students of the forces that affect it.
Okay, I get it too. So what are these forces then?
Fundamentally, we are assessing the forces of supply and demand. If demand is greater than supply, a free market's price will rise until demand subsides or supply increases. And the opposite is also true. If supply is greater than demand, then the prices will fall.
I'm a bit lost, Philip. I understand the concept, but how does this relate to my trading?
Well, as traders, when we analyze free markets, we are trying to understand supply and demand, because this determines the price. The techniques we use might differ, but this is always at the heart of what we are trying to do. We are actually going to look at 3 types of analysis later in the course.
Okay, I get that. So we're always assessing supply and demand.
Yes, that's right. All roads lead back to supply and demand. Next, we will look at the different types of markets.
In the last module, you mentioned over-the-counter markets. Is this what you're referring to here?
Yes, there are 2 distinct types of markets, OTC and exchange traded. You might be more familiar with exchange traded, so we will start there. An exchange is centralized, so all trades are routed and approved from a single central source. Stock markets are a classic example. In the UK, this is the London Stock Exchange. All the large UK shares go through it.
What do you mean they go through it?
Well, the exchange runs something that's called an order book. For the big shares on the London Stock Exchange, this is called SETS, which is short for the Stock Exchange Electronic Trading System. Brokers and participants with a seat at the exchange can place orders on SETS. If the order is matched by another participant, it becomes a trade and it's settled.
Okay, I understand. This sounds like a pretty straightforward way of trading.
Yes, it's a great way to trade standardized products like cash share trading. Getting all the transactions in one place means it's a safe, level playing field. Small private investors get access via a broker to the same market as a large investment manager. As a trader, you get peace of mind that there is a well-established oversight throughout the exchange.
Okay, but you're going to tell me there's a drawback to exchanges, right?
Well, yes, there is. Before the internet, exchanges used to add lots of value by encouraging people to congregate in a physical location. However, in today's digital age, exchanges are relatively expensive. They also don't work too well with innovative or customized products like CFDs or new markets.
Okay, so the alternative is OTC?
Yes, OTC is decentralized. It's just two parties trading directly with one another. There is no central exchange. This is what happens in the majority of the FX, bond, CFD and spread bet markets. In these markets, there aren't any large central exchanges running order books and processing all the trades. OTC allows finance to be innovative. Without OTC, I don't think you'd be able to spread bet or trade as efficiently as you can now.
Okay, but there must be drawbacks to OTC as well, right? Otherwise it would be used for all types of trading.
Yes, there are drawbacks too. As private traders, you can't access the same markets as big banks. Think back to the last module when we were discussing debt markets. You can't buy Ryan's credit card debt, but a hedge fund or a bank can. When trading is not centralized, it places a greater emphasis on that country's financial regulator to ensure that practices are all above board. This means ensuring brokers and other financial service providers behave fairly and are properly funded to meet the risk that they are taking on.
This is getting a bit complicated. How exactly do regulators ensure everything is fair?
Well, don't worry. We will get into regulators later in the module. For now, you should be aware that there are two different types of markets, and unless you end up trading cash shares or maybe commodity futures, you will probably be doing this on an OTC market.
Okay, sounds good.
Next, let's look at what traders actually do when they trade the market, or in other words, buying and selling.